on TV, online and on your smartphone. This is Ticker News.
This episode of Talk Your Book is proudly brought to you by Honan, providing a complete range of insurance, risk and financial solutions.
Fundies called me up, told me to take a look, but stay stubborn as bulls and talk their own book. Get the money, get the money, get the money.
Hi, I'm Chris Judd and this is Talk Your Book, and today we're lucky to be joined by debutant Adam Saunders from NGE Capital. Adam, thanks very much for coming on the show.
Good to be with you, Chris.
Now, before we get into your stock pick, maybe if you can tell us a little bit about NGE Capital and what your guys' investment framework looks like.
Yeah, sure. So NGE Capital is an internally managed listed investment company listed on the ASX under the ticker NGE, and we offer investors exposure to an actively managed concentrated portfolio of high conviction investments. We have a very broad mandate, so actually as broad as the investment the ASX listing rules will allow. So we're not constricted by geography, asset class or security type.
But long only?
Yeah, essentially we end up long only. We focus on listed ASX and international equities, and we just look for investments that we think will provide a good risk reward over the hold period. And since we've converted that entity to a LIC 8 years ago, we've achieved 13% per annum returns net of fees and expenses.
Outstanding. And what stock did you want to talk about today?
So Pioneer Credit, PNC is the ticker, listed on the ASX, listed since 2014, founded and run by Keith John, founded in the early 2000s. It is a debt recovery specialist that purchases and then manages unsecured retail debt portfolios, and those debts are typically past overdue by 180 days or more. They call those portfolios purchase debt portfolios, or PDPs, and they buy them off the big Australian banks, credit institutions in Australia. Those vendors, those vendor partners as they call them, are typically also the originators of the debt. Once purchased, and they typically sell for a discount to face value. We're talking they buy them at 10 to 20 cents in the dollar, that kind of range. And then once purchased, Pioneer works closely with the customers to facilitate repayment of the accounts, either by entering into payment arrangements or via negotiated settlements. And it hopes to do that, or aims to do that in an efficient, ethical and compliant way.
And so, full disclosure, we've got a position in PNC as well, so it really is a Talk Your Book type setup today. So let's dig into the PDP market and the competitive landscape. I guess they're currently operating in more or less a duopoly with Credit Corp. There's been some smaller operators over the journey, but more and more of them are leaving the market. Just what are the benefits of that from Pioneer's perspective, and why are the banks more comfortable selling those PDPs to a group like a Credit Corp or a Pioneer Credit?
Yeah, so if you go back maybe 5-6 years ago, there were probably 6 or 7 key players in the industry, and that's now shrunk to, as you say, 2 key players and maybe 2 smaller players. The market contracted over that period. It went from $500 million in annual sales down to around 300 mil, so 40% decline, pretty big decline. And the reason for that was increased regulation, partly stemming from the Hayne Royal Commission into misconduct in the banking financial service sector. That report was handed down in February 2019, and since then there's been heightened scrutiny on financial services and also in debt collection. So that contracted the market. Banks were they paused a lot of sales of PDPs, and through that increased compliance cost that came along with the increased regulatory scrutiny, that saw a lot of players exit the industry. The other main player in the industry is Credit Corp, which is listed on the ASX, ticker CCP. They have actually been a big consolidator in the industry. So they acquired Collection House, which went into administration. They bought it out of administration. They acquired Bay Corp and a number of others. You've also seen competitors go bust. They either paid too much for their PDPs or they couldn't meet the compliance costs. And the net result is you've got two established players. Vendors want to be sure that who they're selling to, the entities they're selling to, the buyers of the debts, are going to look after their customers. So they want their former customers to be treated right in a compliant fashion and with the respect that and to a certain standard. So it means that it's good for the likes of Pioneer. They have a steady flow of these purchased debt portfolios, and it's good for the vendors because they know that they're going to look after their customers.
And you mentioned that PDP market shrinking over the last few years. Do you see that growing from here?
We do. So Pioneer estimated the FY24 market size was around 325 mil. They reckon it's going to grow to 400 mil this year, largely driven by the return of a dormant vendor, one of the big banks that's been out of the market for an extended period. So that should drive a lot of that growth. You've also got part of the reason for that contraction was you had the heightened regulation, more prudential lending standards, higher interest rates, and also COVID hit, and you had that sensitivity around hardships of their customers. So banks were less willing to, they paused selling. But now seems like the Goldilocks time to be selling. You've got stable and high employment, and arrears, starting to tick up a little bit.
And talk us through the FY24 results, which we felt was sort of almost a turnaround year after a challenging few years in the market. How did you view those numbers?
Yeah, it did seem like a bit of a messy result. They had a lot of one-off costs in the results, so related to a debt refinancing that they've recently done. They also took a precautionary impairment to the book value of their receivables, an across the board cut to the book of around $18 million, which took it down from sort of 340 mil to 322.
Even though they stated they hadn't seen an increase in bad debts or a lessening of the quality of their debt portfolio.
Yeah, so it was due to, I guess, the uncertain macro environment. That was the reason given. And arguably, if conditions stay as they are, that's a potential future source of profits. They may get written back, those provisions. If conditions do deteriorate, then arguably they've taken their medicine up front.
And they also left the FY24 results with a significant deferred tax asset. Talk us through that and talk us through how long it is before you think they'll be paying any tax.
Yeah, so they have roughly 80 million of accumulated losses on the balance sheet. They did recognise a deferred tax asset in the FY24 results, so that it's around $20 million. They've forecast, the reason they gave for, acknowledging that tax asset is that they expect to generate profits over this 3-year forecast period, sufficient that they'll be able to apply those tax losses.
And so, talk to us. You mentioned some of the messiness around the results. The one-off costs related to the debt refi. I think it was $6 million was the headline cost for the one-off cost from the debt refi. Is that right?
Yeah, that's right. Yep. And
talk us through just how much savings that debt refi is going to offer up in the next year or two.
Yeah, so it was a long telegraphed debt refinancing. They've been talking about it since 2023. It finally got done and signed on the 1st of July. The facility size was being upsized to 270 mil, drawn to about 220 mil. So they've got 50 mil of spare capacity to buy additional PDPs. But it was at a much reduced interest cost. So it should result in 7 to 8 million of interest savings per year based on the current drawn amount, which is material given those tax losses that they can apply. It should just fall straight to the bottom line. In terms of the actual rate, it went from the swap rate plus 825 basis points down to swap rate plus 550, so material saving there.
And they've also got a court case looming against PwC for some advice they received, which they felt was erroneous back in the COVID years. How are you viewing that case, and what sort of upside, if any, have you put in your model for that?
Yeah, so I guess to understand the case, you have to go back to 2018. From the 1st of July 2018, there was a new accounting standard introduced, AASB AASB 9 financial instruments. I don't know if you've read it, but it's a pretty dense and dry doc.
I haven't read it, but I know it makes financial statements very hard to understand.
Yeah, so basically the crux of that that new standard meant that from the 1st of July 2018, Pioneer should be valuing its PDPs at amortised cost rather than at fair value, which had been doing previously. Now, at the time, they thought that they could continue to value their PDPs at fair value. That wasn't the case, and in fact, fast forward a year later in 2019, and the shares were suspended. They breached a financial covenant, and then COVID hit shortly after. So it kind of hit them right at the wrong time, this issue, and so yeah, they're going after PwC for the costs they incurred as a result of that financial breach in 2019. They've commenced court action in the Supreme Court of WA. They're seeking 27 million in damages plus interest. We haven't factored that any favourable outcome in that case in our base case valuation, but against the market cap as we sit today at roughly 90 mil, any favourable outcome there, a settlement or even the full amount would be material.
Yeah. And so maybe let's get into what the future looks like. What sort of numbers? Well, I mean, PNC have put out pretty clear numbers for FY25. What sort of numbers are they saying they'll do on a $90 million market cap?
Yeah, so they're forecasting NPAT of 9 million plus this year. A lot of that seems conservative to us, given the interest savings from the debt refinance that we talked about, which is could be 8 million this year. So they're not factoring much profit from the operating business, but given that they're currently buying PDPs at much better IRRs than historically has been the case, and they have very good visibility on not only what's coming down the pipeline in terms of purchases, but also how the book's performing. We suspect that there's upside to that guidance. And
you're right, because NPAT A, once you take out all the one-offs, was a touch over $1 million. So you just throw the debt savings in, you almost get to the number that they've forecast to already.
Yeah, that's right.
Do you think it speaks to a management team that had been through the ringer, with the PwC issue almost going under and then dealing with COVID? You would expect they'd have a strong desire to under-promise and over-deliver, given the recent history. Do you think that's a reasonable assumption? Yeah,
and credit due to Keith John, the management team, for just getting the company through what's been a really difficult sort of 5-year period with the accounting issue. They had an offer from Carlyle, the PE firm, which got terminated. They had to refinance on extremely punitive terms in 2020. Then COVID hit, which crimped the PDP portfolio industry in general. So it's kind of now that they're just getting back to, I guess, finding their feet and really setting up the business for future growth. And I think any survival of that kind of experience you'd want to be conservative in your outlook, I think.
And they've also given numbers to FY26, and their long-term incentives of their management team are reliant on hitting these numbers. So what have they guided to for FY26?
Yeah, guiding to NPAT of 18 million plus, which seems kind of crazy when you look at the current market cap and what they're expecting to do this year. They're heavily incentivised to hit those numbers, so 8.6 million performance rights are outstanding, and due to management, they'll vest upon achievement of that NPAT target. A lot of the growth in that NPAT number is coming from revenue growth, so they're obviously expecting to derive additional cash collections from the purchases they make this year and next year. So it does seem aggressive. They seem very confident that they're going to make those numbers. And that's kind of what has got us very excited about this investment.
And they've been explicit that they can't rewrite up the PDPs up like they wrote them down to hit those numbers. They've got to be from
that's right.
the operations of the business.
Yeah, it's got to be from the operations. They can't also derive any benefit from the any future tax assets as well. You know, if they value any tax assets as well. Yeah.
Awesome. Well, thanks very much for walking us through it, Adam. It was great to meet and great to get your views on P&C.
Pleasure. Thanks, Chris.
And thanks to everyone else for watching Talk Your Book. We'll be back to do it all again this time next week.
You're watching Ticker. We'll have more in just a few minutes.